understand what's going to happen this week. He's HSBC's co-head of Asian economics research. There's a lot of speculation that NPC is going to come out with their goal of 7% for China's growth goals. But there's already some of you in the know who say we're already below that.
Well, the latest data suggests the economy still has decelerated. Just look at the PMIs. Yes, February was a bit better, but generally speaking, things are not looking too solid right now on the mainland. So when they come out with a growth target of 7 to 7.5%, it may mean that they have to unveil more stimulus measures to lift the economy back up to that particular growth rate this year.
Well, we got a surprise over the weekend, didn't we? Everybody thought that they were off for the weekend, and in fact, PBOC cutting rates for interest rates, also deposit rates as well, and trying to stoke the economy. This right ahead of the contraction in PMI that we saw come out the day later. Is this it, or can we expect more?
There will certainly be more. We think that at least a couple more rate cuts, for example, triple R cuts as well, just to infuse more liquidity, make more money available. But that's not it. We also need to see probably some fiscal measures to support infrastructure spending, and perhaps most critical of all, measures to support the real estate market. We think about the Chinese economy, it's really all about real estate, and maybe loosening some of the purchase restrictions for homes, for second homes, for example. That would give demand for real estate a bit of a lift, and I think that's also still in the pipeline.
I mean, as China kind of redirects its economy away from infrastructure-led credit growth of an economy to a more domestic-driven one, it really still is, though, the property sector, as people, if they feel confident, they're going to buy those homes, they're going to buy furniture, they're going to move, and all of these ripple effects, but we're not seeing it. The pressure is there. It's deflationary.
It's still deflationary because what we have in China is not so much a real estate bubble. We have a construction bubble, especially on real estate, housing, for example. And as that deflates, it puts pressure on much more sectors: steel, glass, cement, cars, furniture. All of that gets dragged down as well. So we have to accept that the construction will have to slow in the coming years. It's just the speed with which it starts to deflate. That's critical. And luckily, the Chinese have the tools to fine-tune that, add more liquidity when things topple over too quickly. But at the end of the day, it has to shrink as a share of the economy.
Well, we've taken a look at the falls in RMB, and when it comes to the FX markets and the red back, as you call it, I mean, is there further room for it to fall, or do you think it's going to be propped up by the Chinese?
Slightly more. We think there's going to be a bit more easing coming through, but we wouldn't go as far as saying that the Chinese are going for the nuclear option here and aggressively devalue the currency. It's just not in their interest, because what's lacking in China is not so much export competitiveness. They are actually very competitive still. They have a trade surplus. What matters is getting domestic demand going, and one way to do that is to keep actually a stronger currency, not a weaker currency. So if you want to spur household spending, it's better to have a stronger currency. And so yes, there might be a bit of weakness coming through. Last week we saw higher fixes, for example, that raised speculation that China might join the currency wars, but that's a bit too simplistic, we feel, and so slight depreciation, but nothing too dramatic. If they go for a nuclear option, that would be very challenging for the rest of Asia.